And that's why I think gold is performing so well, and why gold, I think, is close to a 20 to about 40% rally, depending on what happens over the next really week or two, or really actually just next week. I think we're going to have a significant change where we have big trends, either up or down. We just have to let these assets break out.
Fresh rallies on Friday as tariffs kick off officially. So ironically, or perhaps not ironically, tariffs are actually making stocks rise. We'll talk about that. And gold hitting new all-time highs today on Friday. We'll talk about that as well and what's next for metals and markets alike. Chris Vermeulen joins us once more. He is a chief market strategist at thetechnicaltraders.com. Chris, welcome back. Good to see you again.
Thanks for having me, David. Always a pleasure.
People can always check out my last interview with Chris and revisit his last calls from a few weeks ago, linked down below. Let's start with the stock market. The S&P's up roughly 70 basis points as of 1 p.m. Eastern Time. We're speaking today on Friday the 8th. The Nasdaq's up almost 1%. Gold's up 1%. We'll talk about that. Let's talk about the stock market first. So I don't know if you're surprised that tariffs kicking off would actually boost stocks, but perhaps it's rising for other reasons. Anyway, I'll let you take a look at the technicals and see whether or not we're on the verge of a new fresh breakout here, Chris.
Yeah, sure. The tariff news is always news is generally pretty random. You don't know when it's coming out, and you don't know how the market's going to react to it. And the more of the same news that comes out, that's always repeated tariff stuff, you start to go numb to it after a while, because whatever is said, gets retracted, or who knows. So it's very tough to trade around news. The stock market moving higher, I think, today, and really over the last couple of days when it has been pushing higher, is very much so related to the Magnificent Seven. When we look at the S&P 500 and the Nasdaq are both very close, striking distance to breaking to new all-time highs again. And really, it's the Magnificent Sevens that are pushing things up. We're seeing big moves in NVIDIA, Tesla, Apple. All of them are really pushing and driving this market up. What's really interesting here, though, is we're at this really, really critical turning point. If we look at the overall trend, if we look at my trend analysis on the stock market, this is the S&P 500. More or less, we had the exit trend sell signal with the tariff crash. We had a new trend start. And just this week, we ended up closing out our equities position up here near the highs, because the technicals are actually breaking down. A lot of technicals and sentiment. The market's actually not very strong, but the Magnificent Seven are doing pretty much all of the heavy lifting. And so right now we've moved to the sidelines and we're waiting. We could see this market kick back into an uptrend, and this will be a nice reset to put our portfolio right back in and catch the next leg higher and things like that. Or it might sell off and go into a bigger correction. And as I was mentioning to you before, just before this, David, if we look at this comparison chart of this year of the NASDAQ, the QQQ, and last year over pretty much the same time frame, we both had a big, significant April low. We had a massive multi-month rally, and we had a very similar type of trend reversal and breakdown in the markets. And that's what we're seeing right now. And our system has identified it again, saying, hey, the same shift is happening. Move out of the markets. Let the market figure out which way it's going to go, and then we can take action from there. So last year we saw the markets fall about 15% down to the April pullback. The same thing could happen this year. Maybe it could be 25% because we're a lot higher. So anyways, there's an interesting scenario here. And the price of gold, which is the other half of what we're going to talk about, is also signaling that this a big correction is here. And gold is one of the biggest, it's kind of like a global barometer that we're going to go into some financial crisis in a big way. And that's why I think gold is performing so well, and why gold, I think, is close to a 20 to about 40% rally, depending on what happens over the next really week or two, or really actually just next week. I think we're going to have a significant change where we have big trends, either up or down. We just have to let these assets break out, whether it's gold or the stock market going forward.
So next week is going to be critical for spotting new trends, just to reiterate.
Yeah. Next week is going to be a game changer, I think. Set some
what
new.
What do you mean?
Yeah.
Big correction is here. Are you referring to something imminent in the works in terms of correction? Because you mentioned that this is mirroring 2024, and as we know, in 2024, most of that year was up.
So what you mean. For that particular scenario, so let me just backtrack here. So I'm expecting if we see this correction, obviously it could be a 15 to 25% correction. It could bring us back down to the lows we saw earlier this year. But when I say something really big, that actually brings us back to the stage analysis where we look at these four stages of the market. And I believe we could go off this cliff into a stage four, a financial reset, a bear market. Like we're talking a tech bubble burst, a multi-year bear market, the financial crisis of 2008, the 87 crash. We could see a huge financial reset. And gold has been warning that something bad is coming because it's been going up and it continues to hold its value. Interest rates, when we look at the 10-year, I mean, nobody really wants to see this because it's going to be really painful, but the 10-year yield has a very strong chart pattern. When we go way back in time, everybody's used to falling rates because that's what most people just kind of grew up with. But this was a stage 3 topping phase. It went into a stage 4. We've just seen the interest rate market more or less put in a massive bottom, and it has a launch pad to start a new bull market. It is pointing to an 8% rally. Obviously, if that was to happen, it's going to wreak havoc for the economy, for the world, for stocks, for real estate, and all of that stuff. So that is like when I say something really bad could happen, that could be the scenario. That's what interest rates are pointing to. Gold has been warning us for a while. So that's like the worst case scenario. Obviously, the comparison of 2024 is saying that would be the first leg, the first potential pullback to be aware of going forward. But we really just need to wait and see. We just need to give it a few more days. Don't get worked up. Let the market guide us. There's a huge difference between timing the market, which is what most people try to do. They try to pick a bottom. They try to guess a top versus following the market. Let it put in a top, let it roll over, and then identify the trend. Let it find a bottom. So that's what I do. I follow it. I don't get all antsy and try to split hairs and pick tops and bottoms. I let the markets guide us and just follow. It's way easier to follow than it is to predict the future. So hopefully that kind of explains we could have a pullback that could lead into a financial, reset.
What was your reaction to last week's pullback, last Friday's pullback in particular? That was the day that the jobs number revision came out, and that was also the day that new tariffs were announced. So yeah.
If we look back, I mean, it was really, it's just a pullback. People were nervous. People were selling. The type of price action that we saw was the market gapped higher and it sold off with strong volume. The intraday charts were very bearish. The NASDAQ, similar. It did a big gap up to new all-time highs and then had 2 days of heavy selling. Those are generally signs that we're very close to a top. Big distribution selling, meaning huge portfolio managers are dumping money, selling stocks, lightening their portfolio of equities into these rallies. And right now, this is the scenario that people need to be aware of. Is the market internals are breaking down. We had a sharp sell-off, and now they're drifting higher with just the Magnificent Seven actually really lifting prices, drifting back up. At any day here, it could get clobbered with a big red bar, and we could just fall off a cliff. So that's why we need to let this market just finish this transition and see if it has legs to the downside or if it is actually going to turn back up and some of the underlying technicals strengthen and we get a new buy signal and we hop in for the next magnificent rally, more or less, is what I think it will be.
You've heard me talk a lot recently about rising gold prices and how important it is to be building your savings in hard assets like gold and silver. But what if I told you that you could do a lot more than just holding gold? What if you could also earn income from it paid in gold? That's exactly what today's sponsor, Monetary Metals, is doing. They're revolutionizing how people invest in gold and silver. Instead of paying to store your metal or watching it sit idle, now you can get paid to own it. Right now, in their marketplace, you can earn up to 4% interest on gold paid in gold. That means your holdings grow in actual ounces, not dollars, on top of any price appreciation. Interest is paid monthly in physical gold, which you can redeem and take delivery of. Thousands of investors are already earning real interest in physical gold and silver through Monetary Metals every month. It's time you did as well. Go to monetary-metals.com/Lin, link down below, or scan the QR code here to learn more and get started. Sorry, the next magnificent rally after or before this big correction?
If the stock market can continue to hold up, we could have it could trigger a new rally. And
Yeah.
and it was kind of playing off things. We had a magnificent rally since the lows this year, and this move up is done by the Magnificent Seven right now. So we could have another, magnificent rally to the upside, more or less in equities and things going forward. So it would be continuing on. The market just turns back into an uptrend here next week, and maybe it wants to keep going higher.
So I'm wondering how long this consolidation for the stock market needs to last before you're convinced that a new rally is here to stay, or it's poised for a breakdown.
It doesn't need to last long. It could give us a trigger literally by the end of today and telling us to get long Monday at the open. It could take a couple of weeks. It really depends. The S&P 500 is further away. It might take next week or 2 weeks to generate a trigger, depending on how it trades. But the Nasdaq is definitely outperforming. It's closer to an upward trigger. So I think next week we could see, if this holds up, we could see the new uptrend start. So it's pretty much here. These resets we have had in the past, where a reset only lasts 2 or 3 days sometimes, and then boom, it allows us to get back in with a full position on the market and start hitting targets again. It's actually a good thing, because what happens is, if we were to look at the markets here, you get in, we hit a profit target, we trim some profits off, we lock in gains, we hit another target. So now we've raised cash. And so what these resets do, and what this strategy has got built into it, is it tells us when there's a reset, so that we can put all of our money back in and get fully invested for the next high momentum move to the upside. So this is a good thing. We want to reset. And if it takes a couple of days or a couple of weeks, it doesn't matter. But that's kind of how we navigate it.
Let's take a look at this article here from today. Gold hitting new record highs on tariff uncertainty. So according to CNBC, U.S. gold futures hit a new record on Friday amid uncertainty over whether country-specific U.S. import tariffs would apply to the most commonly traded sizes of gold bars. Spot prices, meanwhile, eased but remained on track for weekly gains. This is from Bloomberg. Reuters, rather. Sorry. Global shares rose on Friday. Gold shares up as well. So while gold futures rally on a report of duties on U.S. imports of bullion bars, that raised spot prices as well as bullion prices. I'm sure the premiums on bullions are skyrocketing today from dealers. I'm not sure, but I presume they are. Anyway, let's talk about gold's new record highs.
Yeah. So it's really interesting. So when we look at, this is the daily chart of gold futures, you can see today gold hit new all-time highs. But, I believe gold is on the cusp of a big breakout and a big move. I do like, when I'm trading gold, because I am looking at getting into gold for a trade to catch this projected move to the upside, which let's just take a look at this projected upside. So using technical analysis and Fibonacci extensions, we can get a gauge of where the next upside moves for gold will be. And based on Fibonacci extension, it is showing us that we should go to $3,725, potentially all the way up to about $4,100. So there's about 18% upside from here. Now, I'm excited about it, but I don't really want to get into it until gold breaks out to new highs. And you're going to say, well, it has broken to new all-time highs. Well, the way I like to follow gold is actually through regular trading hours, 9:30 to 4. That's when the majority of volume is traded. That's where price can't be manipulated as much. And because what we saw today was a spike up in gold as, London exchange opens and closes, and pre-market and post-market. There's easy manipulation and movement. And so gold had that spike. The best way to look at it is to look at like an ETF, the PHYS, like the Sprott Money Management, the gold ETF. If we zoom in here, you'll notice, if I draw a line across the highs here, we haven't really broken to new all-time highs yet. I want to see gold on a regular trading hours only chart break and close above here. And then I'll be like, okay, gold has now broken out. It's starting another run. This is going to be a significant one. And there's a few other things that are really juicing gold to go higher. We have one of the simple ways to look at it is just the seasonality chart. You and I have looked at this a few times, David, but here we are literally at the low where in August, like pretty much right now, where gold usually turns around and rips higher for 2 months. So we have now a tailwind behind gold, behind our bullish chart pattern. So that's a really bullish sign. And the other thing to look at are, we've seen gold and silver miners. They have now broken out. They've already broken and started to run. And when we're in a very unique precious metals specific, like rich environment, like I feel like we just finally turned into that. Gold miners tend to lead the way, meaning gold miners will rally 3 to 7 days before physical gold breaks out. I've seen this so many times in the past. So the miners give us this warning, and now we're like, okay, now that we know it's about to run, gold should be the next one to follow suit. Because the smart, aggressive, savvy money who realize this market condition we're in, they moved into miners because they see gold going higher and they want to take a leverage play on it. And so that's why I really like gold. Is it's a day or two away potentially from breaking out and starting a significant run.
Why did you say that earlier? Gold running up could signal a correction or some sort of pullback in the stock markets. What's the relationship here, Chris?
Yeah, so the relationship for me, the way I see gold, I mean, everybody sees the market differently, but when gold starts outperforming and running higher, especially in an environment where it feels everything is frothy, things feel out of control somewhat with equity pricing, and what's going on with presidents and rates and all that stuff, gold tends to do really well. A good comparison is, and you and I have touched on this in the past, is if we take a look at this chart on the left. This is the S&P 500 in 2007. We saw the stock market make a high. It had a very big correction to the downside, and then it rebounded and made a nominal new high. Now, gold is the yellow line. Gold was outperforming. It was a top performer, even when stocks were hitting all-time highs. If we look to where we are right now, the stock market has done a similar. It had a big correction this year. It's rallied back. We're now making some nominal new highs. And gold is doing the same thing. It's outperforming. It's one of the best performing assets long-term at this moment. And gold is, when people get nervous, they're scared about stocks, they're scared about real estate, they're scared about currencies, they move to physical gold. They get out of the financial system and they buy a bunch of shiny gold pet rocks and silver rocks, right? That's telling us that people are fearful and that something bad is brewing. Now, if we look at 2007, as the stock market starts to sell down, the candlesticks, gold starts shooting higher. And gold ended up shooting up almost 38% to the upside, while the stock market fell 20%. And we're very close to something similar. The gold daily chart pattern is pointing to a 20% move. Seasonality wise lines up. The stock market is telling us that it's not very strong. It's still going higher, but it's not very strong. It's on the cusp of a big reset. So gold to me is that big barometer saying if gold is going up and outperforming, you got to be aware that some big bad news is lurking out there. We're going to have something hit the market and we won't know until it hits, but it's going to turn the markets around and it's going to crash, and it'll probably be what the next, bear market will be labeled after. So that's where that's where gold to me shines as that very big global trigger saying, be aware. It might not happen yet. Like now, it could be a couple months down the road still, but something big is brewing. And we just need to you have to have a game plan, because when things turn around, especially for the stock market, you better have an exit plan.
What is your allocation right now to stocks, cash, or any alternative assets like gold?
We're 100% in cash. We moved out of the markets this week, closed in a nice trade on the QQQ, SPY, up near the highs. So we are just sitting in cash, waiting for a fresh new trade. And the markets right now are just doing the reset. And hopefully next week we have some new opportunities to get in. I am looking at a few discretionary trades, something outside of my investing strategy, which will be the gold trade. I like gold. I also like an inverse energy stock play like ERY. I think the energy sector space, you and I touched on this probably a couple months ago. I was talking about how what we're looking for in the stock market or for a potential, side play is for the energy space to break down and then come back up and then eventually roll over. And when it rolls over and we get a sell signal on the stock market, meaning the stock market is likely to go down, that could be an opportunity to bet on falling energy. And there's an inverse ETF on this called ERY. It's a 2x leveraged. So as this falls, say 15%, the leveraged ETF will go up 30%. So this is a scenario. We haven't entered it yet. I'm waiting to see the market if we kick into an uptrend next week or not. But I think there's going to be a very good opportunity to play an inverse ETF here. And if the NASDAQ does kick back into an uptrend, which is very close to doing, Bitcoin is actually another one on the radar that will become another potential trade setup. I still have a 136,000 upside target for Bitcoin, but you don't want to hold Bitcoin if the stock market is in a sell signal. As you know, there's a pretty close correlation. If the NASDAQ drops, Bitcoin drops. Not always, but in most cases. So I like Bitcoin, but we do need the stock market to give us a new buy signal before we get involved in Bitcoin.
Hang on, are you more bullish on Bitcoin or with the stock market at this particular point in time?
I'm most bullish on gold right now. That's the one that
Okay.
interests me the most.
All right, but okay, so the Bitcoin price follows stocks then, so you're not particularly welcoming of the next move for Bitcoin, but you do see 130,000 in the cards.
I
So
do.
just
And the reason I like the stock market more than Bitcoin is simply because I know the stock market, it's where I also put all of my money. I don't put my whole portfolio into Bitcoin, but I will put my whole portfolio into the equities market when we have a buy signal. So instead of having a small trade in volatile Bitcoin and knocking it out of the park with a 20% return, I'd rather put my entire portfolio in and catch a 5% return. And it works out to be I make more with the stock market with a big position in a controlled play than to jump into something that's really volatile with a small play. It's just the way that I work. I'd rather be more efficient, have one more steady trade. But that's why I like the equities market more than Bitcoin. But Bitcoin has the upside potential. But again, it's volatile, so it's a small trade. It doesn't move the dial in your portfolio unless you make it a big position, which then you've now just put in a ton of risk because it's a really risky and volatile asset to hold.
how did you come up with a 130,000 Bitcoin target?
So we can just use a Fibonacci extension here. We can go off this low to this initial rally, and then we can bring it back. So there's a couple different levels we can draw from, but this brings us right up to 136. And this is very typical and a very clean setup. We have a rally, we have a bull flag pattern. It's hit the 618. It's pulling back, which is exactly what we want, and then it should go up and hit that 136. It is a really nice looking trade, and I'm looking to potentially get back into it. I'm not saying it's bad. I'm just saying it's not quite a trade yet. And yeah.
Great. Let's take a look at what the dollar is doing today. So, not a lot of action today on the DXY, although huge moves on the on bonds. So, Treasury yields, the long end of the curve are spiking. So the 30 years up 87 basis points. That's huge. Yeah, let's take a look at bonds and the dollar.
Sure. So taking a look at the dollar index, obviously it's been beat up pretty hard, but it does feel like it's trying to reverse direction. We've had what I call an impulse move. So if we zoom into the chart, an impulse move is usually the sign that trend is reversing. An impulse move means you need to break through two resistance levels. So we have this first high right here. And then we have this other standout high right over here. And so when you have a move that is strong enough to bust through two resistance levels, it obviously has some momentum. And after that, you usually have a pause or pullback. It could settle back down into the mid range or something. And then we should start to see it, work its way higher and start an uptrend. So I'm turning pretty bullish on the dollar because I think a lot of it has been worked out already. It feels like it's turned a corner and now it's just coming down to a reactionary low, and then it's going to have a reaction high and stair step its way back up. So that's what I see for the dollar. If we look at the 10-year note here, I mean, we're seeing it's holding its ground pretty good. It's got this big chart pattern. You and I kind of already covered this. But bonds are pulling back today about 0.5%. Let me just zoom in here. Bonds I don't like. They're still in a bear market phase or a stage one basing pattern. We had the top back in COVID. It broke down from a massive pattern, and now it's trying to find a bottom. So I'd be very leery. I think bonds could stay down here for a while. They could even go lower. It really depends on what happens with interest rates and how much trust people have in the United States and how much yield they want, like how much risk, as things become risky, the yields go up, could be a reason why we see the yields moving in certain things. So there's definitely, I would steer clear of bonds. We're at this critical turning point. If gold shoots higher and the stock market rolls over, we're going to see everything go haywire for a while, and it's just going to be all over the place. So that's kind of the tipping point that we're at right now.
Do you look at the correlation between stocks and yields? I know typically when there's a lot of economic growth, they tend to be positively correlated. As stocks go up, bonds go down. They're kind of inversely related, and that way bonds are seen as a diversifier during bull markets. And then there's always also times when they move in opposite directions. For example, in 2022, stocks went down and yields went up. So everything went down at the same time. So do you look at the correlation as indicators at all?
I don't look at them as a correlation. No, I follow each one's price action independently because, as you said, they can move together or they can move opposite to each other. So if you're trying to use that correlation, well, it's going to work sometimes, and you're best just to follow the individual price of each one. Sometimes they'll be moving together, and sometimes they're opposite. But it doesn't matter if you're just following each individual asset on its own based on technical merits.
But the fact that sometimes they move together and then sometimes they move in opposite directions, you don't look at that as an indicator at all?
I don't use it for trading, but for example, like in the last few days, we've seen the stock market move a little bit lower. And on the days the stock market's been moving down, we've been seeing bonds move up, and we've been seeing utilities move up, and we've been seeing gold move up. And that is because exactly what you just said, bonds are seen as a defensive play. And sometimes, if stocks go down, bonds go up. People rotate out of stocks and they go to bonds. So all it's telling me is people are very sensitive now. When they get nervous, they're moving to bonds, gold, and utilities. And so it doesn't counter into any of the trades I do, but it's just nice to know that, people still see bonds as a defensive play when they get nervous. It's really just the way it's always been, but it's not always like that. So you can't count on that relationship. You just follow price.
Let's just talk about some of the things that we haven't talked about yet. Any other trades you're following, Chris, that you think are on the verge of a breakout?
I really think we covered it. I think the exciting play here is gold. I think that's really the most exciting one to me. It's got
what
the
about
cleanest
gold stocks?
You're talking stocks?
Yeah. What about gold stocks, like gold equities, miners? What camp are you putting those in? The gold camp or the stocks camp?
They're in the gold camp, but here's the problem. So, for example, if we were to take a look at what gold miners have done recently. So there's this very significant standout low, this high volume low. We had the rally up, a high volume rally, and we had this pullback. Using Fibonacci extension, if we bring that forward, it has done exactly what it should have done. Gold miners pulled back. They rallied up to the 618. They paused, which is what you want, because if it pauses here, it usually is going to hit the 100% measured move. So gold miners have now hit this move. And in this particular market scenario, it's a very short window that they work like this. Gold miners move first, and then physical gold moves after. So kind of missed that move in gold miners. They finally have come to life and outperformed gold. But now we can be like, okay, let's shift over to gold. Let's play the breakout on gold, which has about a 17, 18% upside move. But miners, if gold break out, miners should continue to move. I'm just not as big of a fan of miners for a couple of reasons. They're more volatile. They sometimes will, if the stock market does sell off, David, and gold goes higher, miners can actually still sell off. And that's because when the stock market goes down, most stocks go down, and gold miners are a stock stuck in the stock market. So by going physical gold, you've got out of that pocket of stocks, and it doesn't matter what the stock market does. Physical gold can keep moving up. So that's kind of the reason why I like gold miners should do okay. But even if you go back to 2007 market top, gold was the number one performer. It held up and made stronger gains than gold miners and silver, simply because it's seen as the global safe haven, whereas miners and silver are more of a North American speculative play. So if you have the whole world moving into gold because they're getting nervous, it has a lot more power and more stability than us North American people being more speculative, trying to pull money out of the market and dance around things. So there's no doubt they'll probably move higher, but gold has actually made more in this same scenario percentage-wise than miners. So why not do physical gold, have a higher probability of winning and making more money than going into miners just because, they can move fast, but not always.
Chris, let's close off on oil. So it appears to me, and correct me if I'm wrong, but it appears to me that $70 a barrel has been kind of a hard resistance level for most of this year. Ever since it started coming down in March, it had trouble breaching $70 a barrel and staying there. It recently breached $70 last week, and now it's back down to $63.85.
Yeah,
I'll let you comment on that.
Yeah, so it has a pretty bearish looking price action, meaning it's pointing to lower pricing. If we go way back in time, we broke down early this year, well below this low. The 66 was a really critical level. It broke below there, and then we had obviously some war, some news kick in, bombs and things, and we saw oil shoot up. Typically, when that happens, gold and oil take off, and so that was a news-driven move, and you can never really trust a news-driven move. And of course, it fizzled right back out. And now we're back stuck underneath this kind of $67 level. So you could pretty much take this whole news-driven move right here and just almost put your hand over or block it out and be like, okay, so oil has broken down. It has then worked itself up into resistance, into this level. It's kissed it kind of goodbye, and now it's probably going to head down and sell off. I think we're probably going to see oil back down at $56, $57. And if that happens, it also means the energy space, the energy sector is going to sell off as well, which is one of the other trades I like, is betting on falling energy stocks. So I'm bearish on oil. It looks like it has a short-term bottoming candle here. It might have a little bounce for a couple of days or something, but overall I do see oil moving lower, and the energy stocks will probably also want to move lower with it.
Okay, excellent. Thanks very much, Chris. We'll close it off here. Where can we go to follow your work? Well, I'll put the link down below, so click on that link. Chris, what can we learn from thetechnicaltraders.com?
Yeah, from there, you can pretty much follow my trade alerts. I manage my own money, my own portfolio, and through the newsletter, I share exactly my portfolio allocations, the exact trades, when to buy, how much to buy, when to sell. Really, I ride the coattails of the markets, and you just copy what I do, and we navigate the markets together. And every morning, I do a video like this in pretty granular detail of all the assets, and we just navigate the markets. We learn and invest and take advantage of rising and falling markets there. And they can follow me on YouTube as well.
Do you trade individual stocks as well?
Only when we're in a brand new bull market, like a stage 2 brand new bull market. That's when I get, into miners. I'll be into uranium stocks, probably robotics. There's going to be huge. So I don't touch them until we're in a time when they're ripping higher. Right now, I'd steer clear of them. It's best to just focus on the major money flowing into stocks, bonds, currencies, or cash. Just catch those kind of tidal waves that roll through the markets for now.
I will put the link down below, so follow Chris there. We'll see you next time, Chris. Thanks for your update today.
Take care.
Very timely as always. Thank you for watching. Don't forget to like and subscribe. See you next time.